I think it's certainly possible. And like I said before, there are people that study those types of questions at a deeper level than I do. But it is one of the challenges that you have to essentially trust what they're saying. And there has obviously been a history of countries kind of dipping into things like that, when they feel like they need to. And so I wouldn't have full faith that those all those tons are there as stated. I even brought up the question before to my audience. I was like, if the BRICS nations, right, they've been talking about doing like a commodity backed currency or partially commodity backed. They're kind of floating ideas out there, and I kind of asked the question like, would you trust their supply audits? And would they trust each other? And then people ask the natural question. I mean, would you trust the United States, especially if there's no audit, right? And so, I think the some of these, kind of sovereign level questions, I think are worth asking because it, yeah, I would say it's not fully clear that all the gold is there as expected, and I think that as you've seen that migration from west to east, I've heard, for example, about those old bars, and it certainly raises questions of how deep in the vault, have they gone. Yeah, yeah, I generally recommend a non-zero position, right? And obviously the sizing can vary based on someone's, what type of capital they're running, what their conviction is in the asset. But I generally think that, zero is not the right number for most people, and that having, some position is worthwhile. And then of course how they want to hold that can differ. I mean, one of the advantages of gold and silver is that you can custody some. It's nice to have a bearer asset. And of course there's also ways that you can link it to like payment mechanisms and things like that. So for people that want that price exposure and are willing to have someone else custody it. And so I think that, especially given what's happening in sovereign bond markets, and then the longer term question about, what are countries going to, use as sovereign reserves if we go through this kind of long term period of financial repression where bond yields are below the prevailing inflation rate, and there's some counterparty risk out there. I think we're kind of entering an environment where gold is likely to be more attractive than sovereign debt in a lot of cases. That doesn't mean every single year. For example, we've had such a sell-off in bonds that I wouldn't be surprised, that now at these higher yield levels they're a little bit more interesting. But I think longer term, there's going to be this financial oppression where paper assets generally struggle in purchasing power terms compared to real assets, and gold would be one of the types of real assets along with silver. Yeah, and I think it also depends on the opportunity set of what else is out there, right? So if you're in an environment where multiple assets are very cheap relative to your assessment of how well they're going to do. So in other words, you have a high rate of return expectation on multiple types of assets. In that type of environment, then maybe people want a lower gold allocation. They want to go out into those, more generating type of assets, capital, to have a higher rate of return. Whereas if you're in an environment where multiple things are very highly priced. Like going back to sovereign bonds in 2019, I mean, negative yielding bonds or near zero yielding bonds. That's basically another way of, and if you have a sovereign bond yield with a 1% yield, it's kind of like saying 100 price to earnings ratio that is not going to grow but is super safe, right? And so does that sound attractive to people? Most people would say no, but then you say, well, what about a 1% yielding treasury? And back then people were like, yeah, that seems fine, or obviously zero or negative in many cases. And so in that environment where the opportunity set of stocks and bonds in general is unattractive in terms of forward returns, then gold becomes more attractive. And historically, if you look at things like the CAPE ratio, the cyclically adjusted price to earnings ratio of the S&P 500, as an example, during periods where it's highly valued, generally the next 10 years, stocks underperform gold. Whereas the inverse is true. If the CAPE ratio gets very, very cheap and you're able to actually get good dividend yields and good earnings yields, and the basically the equities are underowned, then generally going the next 10 years, they're likely to outperform gold. And so I think we're in that environment where it's not at some of the extremes like it was before, but I think the opportunity set out there is really challenging, especially for the S&P 500, these big tech stocks that I think are still somewhat pricey, as well as still looking at much of the global sovereign bond market. And I think that the opportunity set of gold is better than a lot of those over, say, a 5, 10 year period going forward. Yeah, I think during periods of history where we have kind of these just shifts in how the global financial system works, right? So, you had a shift, in say the 40s, you had another shift in the 70s. I think we're in that kind of era now. When you look at charts of major shifts, there's a lot of kind of similarities here. And so I think that investors do have to be aware of the possibility of nonlinear events, right? Where things change, over the course of a year, over the course of a weekend in some cases, and just things are different after that. And then you could have a pretty significant repricing in some assets. And I think gold is kind of near the top of the list of things that could go through a repricing. And kind of by its nature, predicting something like that is impossible or very hard. It's kind of a any given year, it's a low probability event. But I think that we're in that type of decade where some of those low probability events are going to happen. And I think we've already seen some of them. And I think that a shift in how the gold market works and how it's priced and kind of a check to see who actually has the gold is kind of one of those possibilities. And one of the catalysts that I think could, contribute to that is right now, the market does kind of expect that inflation's transitory. If you look at, for example, inflation break evens, for example, like the bond market's forward assessment of what inflation's likely to be, they're looking at much lower numbers than it is now. And I do think that we are in a disinflationary period from the prior kind of that big spike in inflation. So I think in a number of places that the inflation's coming off. But I think that we're still in a structurally inflationary environment when you look at, for example, the energy capex situation. And I do think that once the Fed gets done with their period of tightening, I think that eventually the market's going to have a reassessment of forward inflation expectations, and that could change a lot of investor behavior around how they treat bonds and how they look at gold, right? Because right now with the dollar soaring and with yields going up and investors kind of expecting that inflation is transitory, they're looking at these things as though they have positive real yields, and so that obviously when you can get positive real yield on a bond that can be pretty attractive relative to gold. But if the market reassesses its forward inflation expectations with rates at these levels, and you kind of have reassessment and you start looking at it and say, what if we're in a long period of negative real yields? Then gold becomes, it gets increased attractiveness. And so I think there are some catalysts to look for going forward. And it's, when I was looking at the bond market, a few years ago, it's just like it's like the market was just not looking into the future at all, or at the same time, it's not even looking into the past. It's not looking in terms of history of what happens when bond markets behave like this. And I think we're kind of still in that environment now, where there's not a full recognition, I think, of how trapped a lot of these highly indebted sovereigns are in terms of their ability to maintain the purchasing power of those bonds. And I think that as that becomes more fully kind of assessed and priced in by the market, and as we kind of grind through this year over year, and people kind of realize that some of these issues are going to be with us for a while, I think that could make gold more attractive. And then while you're going through those processes to kind of reduce kind of the games in the market, I think it can kind of like result in a repricing.